What if I gave 5 different beginners the exact same amount of money, just $100, and told each of them to invest it online for the next 4 years? One person buys stocks, one buys crypto, one invests in real estate, one plays it safe with gold, and one quietly invests in index funds. Now here's the crazy part. One of them would have turned that $100 into over $600. Another would have barely made anything, and one would have actually lost money. Most beginners think investing is complicated, that you need thousands of dollars, years of experience, or some secret Wall Street knowledge. You don't. In fact, one of the biggest lies keeping people broke is the belief that investing is only for rich people. Because today, you can start investing straight from your laptop or phone with less money than most people spend on food delivery in a week. But here's the problem. The internet is full of fake gurus screaming, "Buy crypto, stocks are dead, real estate is king, gold is the safest investment ever." And beginners end up confused. So instead of listening to opinions, I decided to look at actual results. Over the last 4 years, I tested 5 different investments using the exact same starting amount, $100. And today we're breaking down which investment performed the best, which one is safest for beginners, which creates passive income, which is most tax efficient, and which one I'd personally recommend if you're starting from zero. But before we start, this is not financial advice. I'm not telling you what to buy. I'm simply showing you what happened when real money met real time. Because investing sounds easy when the market is going up. The real test is what happens over years. So let's begin. 1. Individual stocks. Let's start with the investment most beginners get excited about first, individual stocks. This is where you buy small ownership pieces of companies like Apple, Tesla, Amazon, Microsoft, Nvidia. And honestly, this is the type of investing that feels the most exciting emotionally. Because instead of saying, "I invested in the market," you get to say, "I own part of Apple." That sounds powerful, and sometimes it can make you a fortune, but it can also destroy beginners financially if they don't know what they're doing. Learning curve. For beginners, I'd rate the learning curve high, because successful stock investing is not gambling. A lot of people treat it like a casino. They see a stock trending online, watch one TikTok video, throw money into it, and pray it goes up. That's not investing. Real investors study businesses. They look at revenue, profit margins, debt, leadership, competition, future growth, brand strength. When experienced investors buy stocks, they're not buying a ticker symbol. They're buying a business, and that takes time to understand. Passive income potential. I'd say this is good, because stocks can make you money in 2 ways. First, the stock price increases. If you buy a stock at $100 and it rises to $200, you doubled your money. Simple. Second, dividends. Some companies share profits with shareholders through dividend payments. That means you can literally get paid just for owning the stock. And this is where investing starts becoming powerful. Because eventually your money begins working while you sleep. That's the goal. Tax efficiency. This is great. In countries like the USA and UK, there are investment accounts that protect your gains from taxes. For example, Roth IRA in the USA, Stocks and Shares ISA in the UK. Used correctly, these accounts can save you massive amounts of money long term. And most beginners completely ignore this, which is a mistake, because making money is important, but keeping more of it matters too. Risk level. Now here's the dangerous part. The risk is high, very high, because individual companies can fail. Even massive companies can collapse. History is full of businesses people thought were unstoppable until they disappeared completely. And beginners usually make one massive mistake. They put too much money into one company. That's not investing. That's concentration risk. If that company crashes, your portfolio crashes with it. My results. So what happened with my $100 investment? Instead of carefully researching a stock, I did something stupid. I randomly selected a company, and that company was Samsung. After 4 years, that $100 investment dropped to around $67. Even after dividends, the total value was still roughly a 32% loss. And this perfectly shows the reality of stock picking. Because if I had randomly picked Nvidia, Apple, or Microsoft, the results would have looked completely different. One stock could lose money, another could multiply your investment several times over. That's why stock picking is difficult. You are trying to predict the future, and most beginners overestimate their ability to do that. 2. Real estate investment trusts, REITs. Now let's talk about real estate, because whenever people think about wealth, they think about property, mansions, apartments, rental income. But there's one problem. Most beginners don't have hundreds of thousands of dollars lying around to buy buildings. That's where REITs come in. What is a REIT? A REIT stands for Real Estate Investment Trust. Think of it like a giant pool of money. Thousands of investors combine funds together. That money is then used to buy apartment buildings, shopping centers, hotels, warehouses, office buildings, and when those properties generate rent, investors receive a share of the profits. So instead of buying an entire building yourself, you own a tiny piece of many buildings. Learning curve. I'd rate this moderate. It's definitely easier than buying physical real estate. You don't need a mortgage, tenants, repairs, huge down payments. But you still need to understand what type of properties the REIT owns, how profitable they are, and whether demand for those properties is growing or shrinking. For example, office buildings struggled massively after remote work exploded. Meanwhile, warehouses and logistics properties boomed because of online shopping. So not all REITs are equal. Passive income potential. This is great, and honestly, this is the main reason many people invest in REITs. By law, many REITs must distribute most of their profits to investors, which means they often pay strong dividends. So you can potentially earn regular passive income without managing any property yourself. No tenants calling you at 2 a.m., no leaking pipes, no repair headaches. That's why REITs are attractive for beginners. Tax efficiency. Again, this is great if used correctly inside tax-advantaged accounts. But tax rules vary depending on where you live, so always research your country's laws first. Risk level. I'd call this medium risk. Safer than individual stocks, but definitely not risk-free. Because real estate markets can still crash, vacancies can rise, property values can fall, and economic downturns can hurt rental income. My results. After 4 years, my $100 REIT investment slightly dropped in value, but dividends changed everything. Because while the investment price dipped, the rental income payouts added up over time, and overall, the investment still ended up positive. That's the power of passive income. Even when prices move slowly, cash flow keeps working. 3. Cryptocurrency. All right, now we enter the Wild West of investing. Crypto, the investment category capable of turning ordinary people into millionaires or wiping out entire portfolios overnight. There's almost no middle ground. What is crypto? Cryptocurrency is digital money powered by blockchain technology. Unlike traditional currencies controlled by governments and banks, crypto operates through decentralized systems. The most famous example is Bitcoin, and whether you love it or hate it, Bitcoin has created unbelievable wealth over the last decade. But here's the thing most influencers don't tell beginners. Crypto is emotionally brutal. You can wake up one morning and see your portfolio down 30% in one day, and if you panic easily, crypto will destroy you psychologically. Learning curve, I'd say moderate. Because there's a lot beginners need to understand. Wallets, exchanges, security, private keys, scams, blockchain systems, tokenomics. And security matters massively here. Because unlike banks, if your crypto gets stolen, hacked, or sent to the wrong address, there's usually nobody to call, no refund button. It's gone, forever. Passive income potential. This is moderate. Crypto doesn't naturally generate cash flow like real estate or dividends, but there are methods like staking, yield farming, lending where investors earn rewards. But let's be honest, the higher the rewards promised in crypto, usually the higher the risk hiding underneath. And many beginners chase unrealistic returns without understanding that. Tax efficiency. This is honestly poor in many countries. Crypto taxes are often complicated. Even swapping one coin for another can trigger taxable events. And regulations constantly change. So beginners really need to track transactions carefully. Risk level, very high, no debate. Crypto prices are insanely volatile. A coin can skyrocket 500%, then crash 80%, and most smaller cryptocurrencies never recover. That's why many experienced investors only stick with larger projects like Bitcoin, Ethereum, because smaller coins are often speculation disguised as investing. My results. Now here's the insane part. That original $100 Bitcoin investment, after 4 years, it exploded to over $650. Absolutely crazy returns. But don't misunderstand this. This is not normal. Survivorship bias is huge in crypto. People online only show the winners. They rarely show the coins that went to zero. And there are thousands of those. Crypto can absolutely make money, but it can also expose beginner greed faster than almost any other investment category. 4. Gold. Now let's slow things down, because gold is the complete opposite of crypto. Gold doesn't promise overnight wealth. It promises stability. For thousands of years, humans have trusted gold as a store of value. Empires collapsed, currencies disappeared, markets crashed, and gold survived through all of it. That's why investors call it a safe haven. Learning curve, low. Gold investing is straightforward. You can either buy physical gold or invest through gold ETFs online. Simple. No complicated business analysis. No blockchain technology. No earnings reports. Passive income potential, 0. Gold pays nothing. No dividends. No rent, no cash flow. It just sits there. That's important to understand. Gold is mainly about preserving wealth, not growing it aggressively. Tax efficiency. This depends heavily on where you live and how you buy it. Some countries offer tax advantages on certain gold products, but generally speaking, gold ETFs inside tax-efficient accounts are easier for most beginners. Risk level, medium. Gold is usually less volatile than stocks or crypto, but there's also opportunity cost. While your gold slowly grows, other investments could massively outperform it during strong economic periods. So gold is often more defensive than aggressive. My results. Over 4 years, my gold investment grew steadily. Not explosively, not dramatically, just consistent growth. And honestly, that's exactly what gold is designed to do. Protect wealth, not create overnight riches. 5. Index funds. Now we get to the investment that many millionaires quietly recommend over and over again. Index funds. Not because they're flashy, but because they work. What is an index fund? Instead of trying to pick winning companies yourself, an index fund buys hundreds of companies automatically. For example, an S&P 500 index fund owns shares in America's biggest companies. So instead of betting everything on one business, you spread your risk across the entire market. And that changes everything. Learning curve, low. This is one of the easiest investments for beginners. You don't need to, analyze companies, study charts, predict trends. You simply invest consistently over time. That's it. Simple beats complicated more often than people think. Passive income potential. Moderate. Many companies inside index funds pay dividends, which means investors can still receive passive income. But the real power comes from long-term compound growth. And compounding is where investing becomes life-changing. Because eventually, your gains create more gains, which create even more gains. That snowball effect is what builds serious wealth over decades. Tax efficiency. Again, great when held inside the right accounts. This is why experienced investors obsess over long-term investing, because taxes can quietly destroy returns if ignored. Risk level. Low compared to most investments. Not risk-free, but historically diversified index funds have been one of the safest long-term wealth-building tools ever created. Why? Because you're not relying on one company succeeding. You're betting on the economy growing over time. And historically, it usually has. Final verdict. So after comparing everything, which investment wins? Honestly, there isn't one perfect answer, because every investment solves a different problem. Individual stocks. Highest skill requirement, potentially massive rewards, but dangerous for beginners. REITs. Great for passive income lovers. Real estate exposure without owning property. Crypto, extreme risk, extreme reward, emotionally difficult. Gold, strong wealth protection, weak growth potential. Index funds, simple, reliable, beginner-friendly, historically powerful long-term. And if I'm being realistic, for most beginners starting with just $100, index funds are probably the smartest place to begin. Not because they're exciting, but because consistency beats hype. The biggest investing mistake beginners make is chasing fast money. Real wealth usually gets built slowly. One investment, 1 month, 1 year at a time. And ironically, that's what most people are too impatient to do. At the end of the day, investing is less about getting rich quickly and more about building systems that slowly make money work for you instead of you always working for money. Because if you can learn that skill early, even small amounts of money can eventually become something huge. And the craziest part? Most people will spend years waiting for the perfect time to start, instead of simply starting small today.